Welcome back to the Deep Dive. It is Saturday, January 24th, 2026. And I have to be honest with you, if you're feeling a weird vibrating tension in the air right now, you are definitely not the only one.
Yeah, not at all.
We are staring down the barrel of what might be the most chaotic week for the U.S. economy in, I don't know, maybe a generation.
Chaotic is doing a lot of heavy lifting there. It's almost an understatement. I mean, we have the Federal Open Market Committee, the Fed meeting on Tuesday and Wednesday. That's the 27th and 28th.
Right.
And usually that meeting is, the Super Bowl for finance nerds. But right now, the actual hard numbers are almost getting drowned out by this. This absolutely unprecedented political hurricane swirling around the central bank.
It really feels like we're watching the season finale of some high-stakes legal drama, but unfortunately, it's actually the U.S. economy and, our bank accounts on the line.
That's right.
I have a massive stack of sources today to help us make sense of this. We've got the 2026 economic outlook from Morgan Stanley. We're looking at actual legal briefs from the Supreme Court battle, Trump v. Cook.
We have investment notes from the VRA letter, and then the latest data analysis from Investopedia and Hubbard O'Brien Economics.
A lot to get through.
And our mission today is to try and find the signal in all that noise. We need to figure out how you balance surprisingly hot, maybe even overheating economy with an institution, the Fed, that is quite literally under siege.
From both the White House and the Department of Justice at the same time.
Simultaneously. It's wild.
So let's unpack this. We've got three burning questions we need to answer. First, is the Fed actually going to cut rates next week, or are they, paralyzed? Second, what on earth is happening with the DOJ investigating Jerome Powell in the Supreme Court case with Governor Lisa Cook? And third, we have to look at what this means for you. Specifically, where are mortgage rates going in 2026?
Right, because if you're listening to this, you're probably wondering if that locked-in housing market is ever going to crack open.
Exactly. So let's jump into the immediate future. Tuesday, the Fed meets. The world is watching. Everyone is asking, cut or hold? What are the betting markets saying?
Well, if you're betting on a cut next week, I hope you like losing money.
Aha.
According to the data from Investopedia and the analysis from Hubbard O'Brien, the market is pricing in a 95% chance that the Fed does absolutely nothing next week.
Nothing.
A total hold.
95%. That is wildly confident. Usually Wall Street is a bit more, wishy-washy. Why are they so sure?
It comes down to the data. The economy is simply running too hot.
Okay.
We have to look at the GDP numbers. The third quarter of 2025 was revised up to 4.4% real growth. That's already strong.
4.4% is huge.
It is. But here's where it gets mind-bending. The Atlanta Fed has this tool called GDP Now. It tracks data in real-time shipping reports, manufacturing orders, all of it, to forecast the current quarter.
And what's it saying?
For Q4 2025, they are forecasting growth of 5.4%.
5.4%. Wait, for a mature economy like the U.S., that is a blistering pace. That's emerging market speed.
It's staggering. And when you combine that with inflation, well, that's the problem. Headline PCE was steady at 2.8% in November.
Okay, pause for a second. We always hear about CPI in the news. Why are we talking about PCE here?
Great question. The Fed prefers PCE, personal consumption expenditures. It changes the basket of goods people buy as prices rise. So if beef gets expensive and you switch to chicken, PCE tracks that better than CPI.
Got it.
And right now that number is 2.8%, which is still well above the Fed's 2% target.
So if the economy is growing at 5% and inflation is still nearly 3%, you can't really justify making money cheaper, right? That would be like pouring gasoline on a bonfire.
Precisely, you'd risk hyperinflation. And this reality check is really interesting because it completely contradicts the forecast from just a few months ago.
Right.
We have this Morgan Stanley 2026 outlook in our stack, written back in November 2025.
I was reading that. It feels like it's from a different timeline.
It really does. Back in November, Morgan Stanley was predicting a 25 basis point cut in December 2025, which obviously didn't happen, and another one for this January meeting.
So what were they seeing?
They were expecting the economy to be much weaker, with GDP slowing down to around 1.6% or 1.8%.
So they were expecting a soft landing, maybe even a stall. Instead, we're getting what the VRA letter is calling the Trump economic miracle.
That's the phrase they're using, yeah. The VRA letter points out that the big three sectors, tech, energy, and financials, are powering this massive acceleration.
So a total disconnect.
A total disconnect where the smart money forecasted a slowdown to justify cuts, but the reality is an acceleration that makes immediate cuts impossible.
Okay, so purely on the economics. The economy is booming, rates are staying high for now. But normally, that would be the whole story. We'd wrap up the deep dive there.
Right.
But this time, we have this layer of political warfare on top of it.
This is the part that makes 2026 historic. We aren't just debating basis points or inflation targets anymore. We're debating the fundamental independence of the Federal Reserve.
Let's start with the Supreme Court case, Trump v. Cook. This sounds like something that's going to be in history books.
It absolutely will be. Oral arguments were just heard 3 days ago, on January 21st. The tension in that courtroom was apparently palpable.
For those who haven't been glued to C-SPAN, give us the backstory here. Why is the president trying to fire a sitting Fed governor?
So, rewind to August 2025. President Trump attempted to fire Governor Lisa Cook. Now, the Federal Reserve Act says governors can be removed for cause.
For cause.
And historically, we assumed that meant, criminal behavior or gross negligence, something really serious.
Right. But in this case, the cause was mortgage fraud.
That was the allegation. It was initially pushed by Bill Pult, the director of the Federal Housing Finance Agency. The claim was that Governor Cook listed 2 different homes as primary residences to get better loan terms, one in D.C. and one in Atlanta.
Which, if true, is a big deal. That's bank fraud.
If true, yes. But the defense, and we're looking at reporting from Reuters and the legal briefs here, showed that she listed the Atlanta property as a vacation home on her loan forms and a second home on her security clearance forms.
Okay, so if the paperwork backs her up and says, hey, I declared this correctly, why is this sitting in the Supreme Court? Why didn't a lower court just toss it out?
Because the Trump administration isn't really arguing about the House anymore. They've pivoted.
To what?
They are arguing a much bigger constitutional point, that the president has the authority to fire any executive branch official for cause, and that the definition of cause should be up to the president.
Oh, I see. So the mortgage was just the hook.
Exactly. The argument is about power. If the Supreme Court rules in Trump's favor, cause could theoretically mean, I don't like how you handled your personal refinancing. Or, more dangerously,
I don't like that you voted to raise interest rates.
that's the one. And that's the slippery slope. If the president can fire a central banker because he doesn't like their policy, the Fed stops being independent. It just becomes an arm of the White House.
And what are the justices saying?
Well, that's what Justice Kavanaugh, who is usually quite conservative, seemed worried about during oral arguments. He said allowing this could shatter Fed independence.
Wow. And while that constitutional crisis is playing out, we have breaking news regarding the chair himself, Jerome Powell.
This is the other shoe dropping. Jerome Powell revealed he is under criminal investigation by the DOJ.
And when I first saw the headline, I assumed it was about financial markets or insider trading or something, but it's not. It's about renovations.
A $2.5 billion renovation of the Federal Reserve headquarters. The DOJ has issued subpoenas regarding the costs and the contracts.
Wait, $2.5 billion? That's a lot of wallpaper.
It's a massive overhaul of the complex. But Powell is calling the investigation political intimidation.
So he's effectively saying, you're investigating my office furniture to force me to cut interest rates.
That is the implication. It's hard to ignore the timing. You have a booming economy where rates should stay high, but a president who campaigned on low rates, suddenly the people keeping rates high are facing legal threats.
And the market is noticing this.
Oh, definitely. We're seeing precious metals, gold, silver surging.
Which is usually the fear trade.
It is. When investors get scared that the dollar is being politicized or that the institutions managing the currency are unstable, they buy gold. Stocks are wobbling, but that move in gold tells you that the big money is worried about the stability of the system itself.
So we have a booming economy, but a central bank that is fighting for its life in court. That is a wild backdrop for anyone trying to navigate real life like buying a house.
It creates so much uncertainty, and uncertainty is the enemy of the housing market.
Let's talk about housing. We've been calling it the locked-in market for a couple of years now. Everyone has a 3% mortgage from 2020 and just refuses to sell. Is 2026 the year that finally breaks?
Well, Morgan Stanley describes the market as thawing, but I wouldn't call it a meltdown.
Thawing.
Their strategists do expect the 10-year Treasury yield to rally, which, remember, when prices rally, yields go down.
Right.
They think this will bring mortgage rates down to the 5.5% to 5.75% by the middle of 2026.
Okay, 5.5%. That is not the 3% glory days, but it's a lot better than the 7% or 8% we saw previously.
It is. It's a psychological threshold.
Yeah.
5% feels manageable to a lot of buyers. But there's a catch.
Oh, there always is.
Morgan Stanley expects rates to pick up again in the second half of 2026 and into 2027. So if we hit that 5.5% range, it might be a very specific, narrow window of opportunity.
And what about prices? Because inventory has been the issue. If I'm a buyer, am I going to have anything to look at?
Inventory is climbing, but slowly. Morgan Stanley sees new home starts up about 2% and new home sales up 4% in 2026. But affordability is still the main constraint. The demand is there, but people just can't afford the monthly payments at current prices.
I saw a really interesting parallel in the stack today. We pulled a Reddit thread, which I know sounds informal, but it was discussing real estate in Dublin, Ireland, specifically the D4 district.
Yes, I love this comparison because it gives us that global context. D4 is their super high-end area. And right now, listings there are taking a dip, prices dropping 20% in some cases.
20%?
In some cases. Meanwhile, the average affordable housing in Dublin is still rock solid or rising.
So the rich are finally feeling the pinch, but the average buyer is still in a cage fight.
Exactly. It's a bifurcated market. And we might see that here in the U.S. too. If you're selling a luxury mansion, you might have to cut the price because the buyer pool is shrinking. If you're selling a starter home in the suburbs,
there are still 10 buyers fighting for it.
Because there's just nowhere else to go.
Now we have to talk about something that might be keeping those rates high, the OBBA.
The One Big Beautiful Bill Act.
I still can't believe that's the real acronym. It sounds like a spell from Harry Potter. But this is the major fiscal legislation passed under Trump, right?
It is, and we need to understand this because it's fighting the Fed. The bill includes two massive changes: tax cuts on overtime pay and tips, and an increase in the SALT cap.
Okay, let's break those down. First, the overtime and tips.
This is a direct injection of cash into the working class. If you're a service worker or a shift worker, and suddenly your overtime is tax-free, your take-home pay just jumped significantly.
Which means you spend more.
You spend more. It boosts GDP.
Which is good for the economy, but inflationary.
Right. And then you have the SALT cap, the state and local tax deduction.
Remind us why that matters.
So, under the previous tax code, you could only deduct $10,000 of your state and local taxes from your federal bill. For people in high-tax states like New York, New Jersey, California, that was painful. This bill raises that cap.
So effectively, it's a tax cut for high earners in blue states.
Exactly. So now you have blue-collar workers keeping their overtime and wealthy coastal homeowners getting a tax break. It's a double-barreled blast of liquidity into the system. Morgan Stanley estimates it adds about 0.4 percentage points to GDP in 2026.
But there's a cost to this, right? We're not just printing free money.
The cost is the deficit. We are projecting a $2.02 trillion deficit for 2026.
Yikes. So the government is pumping money into the economy, increasing the debt, which usually leads to higher inflation and higher interest rates.
Correct. It's fiscal stimulus, acting as a tailwind for the economy, but a headwind for fighting inflation. The Fed is stepping on the brakes with high rates, but Congress is stepping on the gas with tax cuts.
And that conflict is why mortgage rates might not drop as much as we hope.
That makes perfect sense.
So if I'm listening to this and I'm thinking about the rest of 2026, the Fed is on hold now. Morgan Stanley thought they'd cut in January. When do they actually cut?
That is the million-dollar question. Despite the pause next week, Morgan Stanley still thinks the Fed will cut eventually. They forecast a terminal rate, that's the bottom of the cycle where they stop cutting, of around 3.0% to 3.25%.
Eventually.
But the timing keeps slipping. If it's not January, markets are now looking toward June for that first cut.
June? That's a long wait if you're floating a credit card balance.
It is. And it depends heavily on the labor market. Right now, unemployment is low, around 4.3%, but the forecast is for it to rise to 4.7% by the second quarter of 2026.
Why the rise? If the economy is growing at 5%, the miracle, shouldn't everyone have a job?
You'd think so. But there are structural changes happening. We have strict immigration controls reducing the labor supply, which usually lowers unemployment. But at the same time, we have tariffs increasing corporate costs.
So companies are getting squeezed by tariffs.
Right. And to preserve their profit margins, they might start cutting costs. And usually cutting costs means cutting people.
So we get this paradox.
We do. High GDP growth because of spending, but a tougher job market for individuals.
The Fed must hate this.
They do. They are caught in a trap. High GDP tells them to raise rates to stop inflation. A softening labor market tells them to cut rates to save jobs. They are stuck in the middle, paralyzed.
And speaking of inflation, tariffs are keeping that sticky too, right?
Yes. Morgan Stanley expects tariff-induced inflation to persist through the first quarter of 2026. They see core PCE dropping, but very slowly, to 2.6% later in the year.
So let's try to summarize this for the listener, because there are a lot of moving parts here.
Here is the snapshot.
Yeah.
You have an economy that is defying gravity with 5.4% projected growth. You have a Federal Reserve that is almost certainly going to hold rates steady next week because of that growth.
But in the background, you have the president trying to fire a Fed governor and the DOJ investigating the Fed chair,
which introduces a level of political risk we haven't seen in decades. If the Supreme Court rules that the president can fire Fed governors at will, the market's trust in the dollar could shake.
So what does this mean for our listener if you're sitting there waiting to refinance?
If you are waiting for 3% mortgage rates, I hate to say it, but they aren't coming in 2026. You might see 5.5% by summer, but that's contingent on the bond market behaving and the deficit not scaring everyone off.
And if you're an investor?
Volatility is the key word. The legal battles, Trump v. Cook and the Powell investigation create uncertainty. Markets hate uncertainty. That's why you see gold moving.
Right.
If the Supreme Court rules against the Fed, or if Powell's actually indicted, all those nice economic forecasts go straight out the window.
It really feels like we are at a pivot point, not just for rates, but for how the system works.
I think that's the key takeaway. This isn't just about business cycles anymore. It's about the rules of the game.
Which leads me to a provocative thought to leave you with today. We spend so much time asking when the Fed will cut rates, but I want to ask something different.
Go for it.
If the U.S. economy is actually growing at 5%, if this miracle is real, while interest rates are hovering around 5%, does the Fed actually need to cut rates at all?
That is the multi-trillion-dollar question. Economists talk about the neutral rate. That's the Goldilocks setting where the interest rate isn't speeding up the economy, but isn't slowing it down either.
And for the last decade, we assumed that number was really low, like 2% or 3%.
Exactly. We thought the economy was fragile. But if we can grow at 5% GDP with rates at 5%, then the neutral rate isn't 2%, it's much higher.
And if that's true?
If that's true, then 3% mortgages aren't just delayed, they are extinct. We might never see them again in our lifetimes. We might be returning to a world where 5% or 6% is the normal cost of money forever.
A sobering thought for anyone looking at Zillow this weekend. We will be watching the Fed meeting next week and that Supreme Court decision very closely.
We certainly will.
Thanks for listening to The Deep Dives. We'll see you next time.